In this section, we continue to discuss our first objectives of applied corporate finance and look at uh, whether we can have any other motive other than the objective of maximization of the share price or maximization of the firm value for any particular firm. Now, as we look at this as an objective, we're going to first lay down our key and major objective with respect to corporate finance, and then see whether that holds in real life. Right. So we have to define the key objective function of any corporate in terms of trying to lay down the foundation of the corporate finance curriculum. Right. Now, the objective in decision making in traditional corporate finance is essentially to maximize the value of the firm, right? And a more specific objective is to maximize stockholder wealth. What do we mean by this? Essentially, if you have the firm value, remember that the firm value is the value of debt plus the value of the equity. Assuming that the debt value is fixed, in order to maximize the firm value, you have to essentially maximize the equity value, right? So the more specific objective that comes up in terms of maximization of firm value is essentially maximizing the stock price in case the company is listed. If it is not listed, you just try and maximize the total overall value of what the equity of the company is worth. So that's going to be our more specific objective, which is we have to essentially try and maximize the stockholder wealth, right? Now note that in a corporate, the stock owners can be different from the managers. In fact, in most of the cases, for most of the major firms, the managers are actually different than the stock owners, right? And then obviously there is going to be some sort of a friction in terms of what is the management trying to maximize. And the idea in corporate decision making is that managers will be the ones who will be making these decisions. So will they be able to maximize the output such that the stock owner's wealth is maximized? That objective is what the eventual decision point in corporate finance comes back to, right? Now, if you think about it, there is a little bit of a criticism around looking at stock prices as the sole objective, right? Let's quickly recap what we were looking at, which is we have already seen that currently if a company has assets, there are certain assets which are already in place. These are the assets which the company has already invested into. It is easy to value these. We have a value available for these. They are available in the market, right? There are other growth assets, which is what will you create. This value is the creation of value from future investments, right? So that's what the company is going to evaluate. Then we have a fixed liability, which is debt. It has to be given out at a certain maturity, and that's fixed for the firm. So in a sense, if we are trying to maximize this, we want to maximize the asset value such that the firm goes. Within this, the current asset value is probably the assets which are already here are kind of fixed. So we want to maximize the value we derive from future investments or growth assets. In turn, that would also maximize mathematically the value of the equity because debt is fixed. Now remember, we are assuming that the debt value or the value to debt holders is fixed here. In real life, we will have to relax that assumption, and we'll look at examples. How do we relax that assumption, right? Now, obviously, there is going to be some sort of a criticism of this. Traditionally, stock prices are assumed to be sort of capitalistic as a motive. So people don't like the idea of only maximizing stock prices, right? Why is that so? Many critics believe that the objective of maximizing stock prices is not in cohesion with employee welfare. So for example, when some companies announce job cuts or fire employees, stock prices end up going up, right? And that's because the stock market believes there is rationalization of costs, right? So it typically believes that a company, in order to maximize the stock price, will try and maximize eventually maximize profits, and that would essentially mean to cut costs, and that cannot be in tandem with employee satisfaction, right? That's one criticism. We'll come back to this. Another criticism is that in order to maximize stock prices, you will have to care less about customers. Your sole motive would be profit, and hence you will have to care lesser and lesser about your customers. There is also a general criticism that in a bid to maximize stock prices, the company will care less about society in general, right? So essentially, you will not be a good social citizen as a corporate, and you would try to use resources or maximize the use of resources. In a sense, you are trying to maximize resource depletion, right? For example, if you are someone who's a mineral water manufacturer, you might actually maximize the depletion of groundwater in the area your factory is in order to maximize your profits today, right? Now, there is some merit to this entire criticism, but what is the reality is that most of this criticism serves a short-term objective for firms. So it is not to say that firms don't resort to such activities, that they don't cut costs in terms of not taking care of employees or not taking care of customers or trying to not taking care of the society. There are always going to be firms who do that in real world. But the crux of this discussion is that in the longer run, this is going to be detrimental to the firm. What's the support to the argument? Companies which are successful over the long run are likely to have happy employees and customers. You will not find a company that has sustained for more than 5 or 7 years. 5 to 10 years is a long enough period. So to sustain, it is absolutely necessary to have happy employees and happy customers. If you don't, the product might be a short-term success, the service might be a short-term success, but it will not run in the long run. So in the long run, it is difficult to have a successful company that does not care about employees or customers. You'll always find that most larger corporates do care about their employees and their customers. Also, companies which do not care about society also face bans, penalties, etc. in the long run, which are detrimental to shareholder wealth. So in order to kind of maximize shareholder wealth in the long run, they will have to follow laws and rules according to the society. If they try to maximize profit at the expense of society, like let's say what probably a tobacco company does or a chemical company does, eventually at some point of time it will come back to them in the form of either higher taxes or in the form of penalties. You cannot endlessly have a scenario where the company is taking the society for a ride. It could increase or maximize profits in the short run, but it is almost certain that it is not going to continue in the long run, right? Finally, you cannot have fuzzy objectives, which is unclear objectives. That does not work. So you have to be clear in stating the objective of the firm and the company. Stock prices work well there since they give instantaneous feedback, right? You can have fuzzy objectives like I want quality product, right? Or I want a happy customer. You can give these as objectives of the firm, but remember, these are eventually outcomes of the actual work that you do. These are not, or these are means to achieve extraordinary shareholder wealth over a period of time. They are not the ends. These are all, so there's two issues. One, this is all fuzzy. This is not clear. How do you define quality? How do you define happy? Usually in real life, it is extremely difficult to have everyone as happy in the context of your doing work, right? Secondly, these are all means. They are not the end objective. They are a way to achieve the end objective. So the objective has to be clear, and their stock prices are fairly clear because you know what you're looking at, and you know that there is a it's easily observable and it's constantly updated. Assuming it is listed on the stock exchanges, it is easily observable at any point of time, and it is updated every day essentially, right? Every day the stock trades, you have a new value. And one of the most important parts is it gives instantaneous feedback. We will debate at a later point of time whether every feedback is right or wrong. But the fact is there will be a feedback, right? So how do we know they give fast feedback, right? Let's look at an example. Recently, the cabinet approved the merger for State Bank of India and its subsidiaries, all the other subsidiaries such as State Bank of Bikaner in Jaipur, State Bank of Travancore, State Bank of Mysore, State Bank of Patiala, etc. Right? The moment this approval of merger happened, there was an expectation that there are synergies that can be utilized. When these banks get together, they will be able to utilize each other's space. They will become more efficient. They will become more efficient, and hence they will be more profitable. Once they are more profitable, automatically the stock price jumped up. So SBI jumped up 3.9%, SBBJ jumped up 20% each. State Bank of Mysore and Travancore hit their highest since 2015. State Bank of Bikaner has hit the highest in 8 months. Essentially, the stock market gave an immediate thumbs up to the entire proposal, right? That's what we mean by fast feedback. Let's take another example. Is it always on the good side? There is a company called VRL Logistics. The promoters immediately thought that they should plan a regional airline. The moment they planned a regional airline, the shares crashed. The stock price went down. Why? It's because it's a profitable firm. So they are a profitable firm, but they're using those profits probably, we don't know the entire story here, to try and create an airline company. And airlines are difficult businesses. Most airline companies in India make losses. So this is a difficult business, and the stock market does not like it. So the stock price instantaneously goes down, right? So we have a scenario where the stock price gives almost an immediately fast feedback, and that's why it is one of the important objectives in corporate finance. Now, if you extend this further, let's see if we can have another objective. Right now, can we maximize earnings, profits? Can we maximize revenues? Can we maximize the firm size? Can we maximize market share? Can we maximize what is called as economic value added? In a sense, you can say that what is the value of the firm minus the costs that have gone into it, right? So you've used someone's money, so value minus capital. That's the economic value you have added, right? In a sense, you could look at these. Note the impact of these functions. Most of them are means rather than ends. They're objectives to achieve the end goal, right? To the extent these objectives fit into the longer term value of the company, they work well, right? But the longer run, there is a problem. What is the problem? So for example, if you want to increase market share or you want to increase revenues, to increase market share, if you give away services for free, you will make the market share, but how will you run the business? So we have the example of Air Deccan, who used to give rupee 1 airline tickets, right? So immediately as you give that, you reach 20 to 30% market share, but you can't make money on this. And you can't run this endlessly because someone has to create money in this business, right? Who will put money otherwise? If your idea is to maximize the market share, there is a huge cost attached to it. Flipkart, e-commerce. At this point of time, all of these e-commerce entities in India are trying to basically maximize their market share, maximize their revenue, maximize the size of the business they do, but not necessarily maximize earnings, and in the long run, not necessarily maximize stockholder wealth. So you can probably have a different objective. As long as it fits into the longer term value of the company, it works well. But if it doesn't, eventually it will boil down to whether the company has created value, and value for both the debt holders and the equity holders, because these are the guys who have given money to the company in order to run the business. So unless these entities create value, these entities, for them value is created by the firm, this is not a sustainable motive. So we come back to our eventual objective, where the firm is this managers, right? There are 4 entities they are dealing with. In an ideal scenario, there is an objective function which we are looking at. There is a relationship between managers and stockholders. What is this relationship? Stockholders essentially hire and fire the managers. How do they do that? There is a board of directors which does that, and we'll come back to this in more detail. And there is an annual meeting that happens, and there they basically hire and fire managers. So the CEO, the business heads, all are basically picked up by stockholders. So they're supposed to be picked up by stockholders. In return, the managers say that we will maximize stockholder wealth. Right? The managers should act in the best interest of the stockholders. The bondholders, there is a relationship between bondholders. So bondholders lend money, and managers are supposed to protect bondholders' interests. So that's why there is this concept of priority of payment, right? So bondholders get their payments first. So that's the relationship between managers and bondholders in our objective function. The relationship between the firm and the financial markets is that the firm is supposed to reveal information honestly to the markets and on time, right? So if I'm going to have a bad quarter of earnings, I have to reveal it properly and on time. I can't delay that revealing of the information. That's assumed in our objective function. And the financial markets are efficient and assess the effect on value almost instantaneously and immediately. So that's the feedback that goes from financial markets to the managers, that the relationship between managers and financial markets is such that financial markets will be efficient. As soon as there is information honestly revealed about the firm, it will get priced into the financial markets. And finally, in the relationship between company and or managers and the society, there are no social costs that the firm has in the long run, and if there are any, they can all be traced directly to the firm. That's the broad objective function we are looking at. If we live in an ideal world where everything is correct, which is what is called as utopia, if we live in a utopian world, we should see this kind of a scenario where managers are acting in the best interests of stockholders and bondholders. They are revealing entire information to financial markets, and they are good to the society. This is what a good company would do. In real life, however, things can change dramatically. So as we kind of look at the applications of corporate finance, it is important to understand the problems that can come up in this objective function, right? How can things go wrong now? It is possible that stockholders have very little control over managers, and managers put their interests over stockholders, right? Managers may be there for only 2 years in between in an entity. So they might want to maximize what they can do in those 2 years rather than whether the firm's long-term objective is achieved, right? They might want to show incorrect numbers to the stockholders, mislead the stockholders, give them incorrect information, which basically is because they want to maximize their profits. They want to maximize their paychecks at that point of time, right? Bondholders lend money, but they are not protected. You borrow, but you default, and you basically default in a way that the money cannot be recovered. So stockholders or managers might be doing fine, but the bondholders lose the money. We have examples on these, so we will look at those examples, right? With the financial markets, you may not reveal the information correctly. Think about it. If you are the manager of a firm and your bonus and your salary is going to be dependent on what performance your company is going to show, there is very little incentive to actually showcase good results. You will actually go and hide bad results. Very, very little incentive to showcase bad results. You will always want to kind of show only good results and hide all the bad results from the markets, right? And even if you reveal the information correctly, there is a possibility that markets are not very efficient and they make a mistake in real life, right? And finally, firms could create high social costs and they are not even traceable to the firm. I mean, technically, if you do a lot of pollution, air pollution, how do you trace what amount of air pollution happened because of this particular firm, right? So some of these things can really go wrong in real life. And how do you assess that a good corporate finance entity or a firm that is kind of having a good corporate finance practice, how does it control all these things? That's the gist of what we are going to cover over the next many sessions under corporate finance, right? Let's look at examples. Stockholders having little control over managers, bondholders left unprotected, provide misleading information to markets, or markets react incorrectly to information, and huge societal costs that companies create, right? Let's look at these examples. So the first one, there's a company called Sun Edison recently filed for bankruptcy, right? So essentially Sun Edison has filed Chapter 11 proceedings, which is essentially bankruptcy. They have defaulted. It's a solar power firm. They have a lot of work in India. It has a sizable investment in India's solar capacity. It faces 24 legal claims, that's cases on them, mainly by shareholders who accuse it of misleading them about its financial position. Publicly traded subsidiaries are also embroiled in lawsuits. So now essentially this is a scenario where the company has misled investors or equity holders, right? So managers have not worked in the best interest of what of the equity holders. Look at this. We recently had this entire case around Volkswagen, where Volkswagen Group had kind of given false statements about omission norms, right? And they caused the bonds to trade at artificially inflated prices. So they have, in this particular case, misled bondholders. So that's the second thing we saw, right? Only to decline after the scandal went public. So people who bought those bonds based on these false and misleading statements, they lost money in this entire exercise, correct? Let's look at another example. When the company does not represent data to stock exchanges, right? The Satyam scam in India, if you read a little bit about it, corporate governance and fraudulent activities practices allegedly in connivance with auditors and CAs. Their auditors and chartered accountants were hand in glove with them. Company misrepresented its accounts to both the board, which is the shareholders, and the stock exchanges and regulators, which is the financial markets essentially. So this is a fraud which misled the financial markets and other stakeholders by lying about the company's financial health. And finally, you could have societal cost, which is, for example, we had this unfortunate Bhopal gas tragedy in India, which is huge societal cost by the firm, and the company that was involved, which was Dow Chemicals, they have never been implicated properly in this entire scandal, right? So there is a huge societal cost which could come up if firms don't do well. In fact, there are studies which basically show that on an overall level, the cost of damage to the environment by business sectors, right? So utilities, power sector does a damage to the tune of $420 billion to the entire sector, right? Basic materials, metals, etc., does a damage of 312. And what is this damage about? So you have greenhouse gases, which is air pollution. You have water abstraction, which is using of water from groundwater reserves and permanently using that out and not really replenishing it. Creating nuclear waste, which could create a problem. Air pollution and acid rain and smog, again air pollution. So almost all industries have a huge impact on the environment. It is how do they minimize this social cost? How do they minimize this social cost is what is imperative to longer term success in corporate finance. With that, we basically come towards an end of this particular section. We will discuss each of these problems in a little bit more detail in the forthcoming section, where we're going to look at how do you minimize these problems that come in real life, and essentially look at in this entire scenario of what can go wrong in the objective function. How do we kind of resolve these issues that come up, right? Before we end, a couple of quick questions for us. Discuss why stock price maximization is the best objective function to have instead of any other objective, and discuss how relationships in objective functions for corporate finance can go wrong in real world.